How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, we're going to be taking a look at CECL, which is also known as the Current Expected Credit Loss methodology, basically for banks. And as far as there used to be the old way of simply just doing kind of loan loss reserves or loan loss provisions. But then banks had to start complying with this new CECL methodology just a few short years ago. And I wanted to check in. I saw a recent blog post from PCBB and basically just wanted to say, hey, that's a great topic and something I really wanted to key in on. So let's bring this up real quick. So how has CECL adoption affected credit loss allowance levels? This is something I have been really, really curious about. So the summary here says the impact of CECL has been different for small and large financial institutions, reflecting the difference in portfolio composition and pre-existing accounting practices between these institutions. And we discuss contributing factors. So until recently, financial institutions were a bit like Lucy when it came to calculating loan loss reserves, letting past data drive their decisions. Yet, just like the videos Henry makes for Lucy to help her take in new information about her life trajectory, they're talking about, what was it? They're talking about like the movie 50 First Dates, whatever, blah, blah, blah. So we'll keep on going there. But just like the videos that Henry makes for Lucy, to help her take in information about her life trajectory, the introduction of the Current Expected Credit Losses, CECL, accounting standard requires affected institutions to turn away from historical data, instead look to the future for their calculations. CECL, which became effective for SEC filers in 2020 and for all other banks in 2023, requires banks to calculate an allowance for credit losses, ACL, based on estimated future losses, not losses incurred in the past. So banks must now record an appropriate lifetime loss reserve whenever financial assets are added to the balance sheet, instead of setting aside reserves only when future losses appear likely. So before we get into this, I got to explain a couple things here. So, okay. How banks are generally set up to prevent or safeguard the bank in the event of loan losses, you have three things. You have kind of like three shields, if you will. You have earnings. So in other words, if a bank takes a loss, the first thing that kind of usually gets hit is earnings. Second thing is loan loss reserves. Basically, if the bank either doesn't want to hit their earnings, or maybe the loss is impacts earnings too much, they have to dip into the loan loss reserves to kind of cover things. So they have earnings, loan loss reserves, and then you have finally bank capital. Those are basically like your three buffers, if you will, to protect against, loan losses at any given bank. What happened in the past with loan loss reserves is you had a little thing go on. Some people, some analysts, you may hear the term window dressing. In other words, banks kind of manipulate certain things to make their performance, to make their earnings and their other numbers look a little bit better than what they actually are in reality. And part of the way that banks can do that is kind of by messing with loan loss reserves. So to give you an example of like, how would that play out? Well, so what generally would happen is you had good times. And in good times, when everything's fine, banks would not put away an appropriate amount into their loan loss reserves. And then things would turn, you'd get a recessionary period or a crisis or something, and things would turn bad. And now you have all these loan losses, and now it kills banks' earnings, and potentially and could potentially hurt capital, because they got to now move more. They got to move a ton of money into loan loss reserves to now offset the losses they're going to have on their credit, in which, again, like I said, impacts earnings, could impact capital levels, could do a number of things, to the bank. And so basically regulators were looking to kind of like, okay, how can we smooth this out, so to speak, so that banks aren't, not putting away, enough. So banks are putting away more money consistently between good times and bad times, so that basically the banks are basically are adequately putting enough money away in good times, so that when bad times come, there's plenty of money there, and it doesn't as abruptly affect, earnings and other things, going on there at the bank. So they kind of came up with this CECL methodology. Now, like it says here, banks used to calculate their loan loss reserves based on loans that actually went bad. It was more of like a historical calculation. How has the bank historically performed over time? And then you kind of look at what are the actual losses. You got to put money aside for actual losses, for actual loans that get, downgraded into criticized and non-performing assets. But the CECL methodology looks at more like a lifetime. And I think one of the criticisms of CECL is it basically assumes that every loan that you make is going to go bad. And then the question becomes, well, if every loan that I make is going to go bad, why would I ever make a loan? So again, I don't like, or I should say don't like. I was never really a fan of CECL when it came out, but basically, like I said, pretty much all banks are now, complying with CECL or performing CECL. I think one of the interesting things about CECL is that it requires a tremendous amount of data. So while initially you were looking back at historical data, CECL also looks at historical data. That's how they ultimately get, the lifetime data, because they look at how the bank has performed. They look at a lot of historical data on the bank, different loan categories, a lot of number of different factors. So I think that it was a giant pain in the butt to kind of get the data and get the things needed to kind of put it together. And there was like 7 different calculations in CECL, and most banks just had to pick like 2 or 3 of those. And of course, a couple of the 7 became more popular than others over time, and I'll get into those in a different episode, probably when I examine CECL in a little bit more depth. I'm just trying to give everybody a little bit of overview and trying to explain to them like how this works and what CECL is or whatever. So, but it was definitely a pain in the butt at the beginning. But then I think once banks got used to, once they were able to compile, collect the data, understand the data, analyze it, interpret it, and then put it into a format that basically could be shared then with senior executives, with the board, with regulators and auditors, and basically everybody could kind of look at these numbers and digest them and say, okay, well, here's what's going on, here's what's happening. So I think having a lot of that data and being able to look at a lot of those historical numbers, I think that's a really actually a good thing. I think it's great that banks have the ability now. I think it was very tough for a lot of banks to get there at the beginning. But I still question the methodology, though, like the way that CECL works, and does it really make sense? Because like right now, you would think that with the current lending environment, with like the extended pretend, all the things kind of going on right now in the lending world inside banks, that the CECL model would basically be forcing them to put more money aside. And you are seeing that a little bit, but I don't think you're necessarily seeing that for like all banks across the board. And that's kind of an interesting thing. So, all right, with that all said, let's just get into a little bit there. So the differences between small and large financial institutions. So according to data compiled by the Federal Reserve Bank of Kansas City, CECL adoption has resulted in an average increase of 3.76% in the ACL of all community financial institutions. However, there are considerable differences in how adoption has impacted CFIs with less than $1 billion in assets and those with assets between $1 billion and $10 billion, with larger CFIs reporting more substantial increases. So according to the data, CFIs with under $1 billion in assets reported an average ACL increase of 3.08%. This compares to a 7.53 average ACL increase for CFIs with between $1 billion and $10 billion in assets. I mean, obviously that's a big difference there. It's noteworthy that approximately 2/3 of CFIs reported either no change or a reduction in ACL due to CECL adoption. So that's really fascinating there. So 2/3 basically said they either had no change or actually had a reduction in their loan loss reserves due to the CECL adoption. The vast majority of them, nearly 92%, were CFIs with under $1 billion in assets. One possible explanation for the less pronounced impact of CECL on smaller institutions is their heavier usage of qualitative factors prior to CECL implementation. This helps smaller CFIs maintain higher ACL coverage ratios. I I'm not sure how much I really buy into that. This idea of their heavier usage of qualitative as opposed to quantitative data. I don't really think that's true. I think it's just more in the methodology. Like, you're again, you were only putting loan losses aside for loan losses that had actually occurred, as opposed to things that may or may not occur in the future. So I don't necessarily agree with that explanation of this use of qualitative, this kind of heavier use of qualitative factors. I'm not sure if I'm really buying that. By contrast, larger CFIs usually have a larger proportion of consumer credit portfolios, such as mortgages and credit cards. These consumer products have shown to be subject to larger ACL increases under the new CECL standard, in line with their longer terms volatility and historical loss rates compared to the equivalent products smaller CFIs have with smaller and mid-sized businesses. Now, to me, that makes a whole lot more sense. To me, that makes a whole lot more sense. Larger banks have, credit card portfolios, mortgages, maybe a lot more consumer loans. So there's, again, longer terms, more volatility, more historical loss rates. So that would make a whole lot of sense there. And then this kind of wraps up here with digging deeper into the data. So the data appears to indicate that CECL adoption has had a less profound impact on smaller CFIs than larger ones. However, the reality isn't quite this simple. CECL has not necessarily been harsher on larger institutions. Instead, the data reflects the differences in portfolio composition and pre-existing accounting practices between large and small CFIs. According to the Federal Reserve's economic research, CECL adoption has led to more timely loan loss provisions that better reflect local economic conditions for CFIs of all sizes. Institutions disclose longer, more forward-looking, and more quantitative loan loss information and have fewer loan defaults after adopting CECL. Maybe we'll see on that. Well, that is a giant maybe. Not surprisingly, larger institutions have seen more significant improvements due to their ability to invest more technology resources and human capital in CECL-related information systems. Yeah, that's probably true. CFIs of all sizes should stay engaged with the evolving accounting standards of the banking industry and their broader implications on portfolio management and risk. So, and then PCBB offers a tool that can help your institution comply with CECL by estimating your ACL. It's called the CECL Fit, and it's a web-based solution. So if you have any interest, you can go check that out. PCBB, you guys can thank me later for the little plug there. But look, I think that what I really wanted to see with CECL was I wanted to see actually a recessionary, a real, not like a pandemic. I wanted to see kind of a normal recessionary period, if you will, where we have a downturn in particularly commercial real estate, and just to see that, see like a 2-year down period and then see things come back out, and then we have some historical data, and we can then see how CECL truly performed in action. Because again, you cannot judge these methods based on good periods. When everything's going good, the numbers are fine. It's the down periods. It's did CECL work as they originally intended it to kind of smooth out the loan loss provisions over the good times and the bad times? And did banks ultimately perform better in bad times with their loan losses based on using this new CECL standard, this new CECL methodology? So that's really what I want to get at. That's really what I want to see. It's like, how is this really performing? And I think that there's a lot of kind of weird and funky things going on right now in the banking business in terms of embedded potential risk in the loan portfolios, with kind of extend and pretend, pushing back maturities, all this kind of stuff, in the hopes that interest rates will come down and then they'll be able to eat more easily, kind of refinance lenders, borrowers, reset interest rates, do new loans, all this kind of stuff. So we'll see what happens. But I thought, like I said, I saw this article. CECL is something that I paid a lot of attention to over the last 5, 6, 7 years, and like I said, I thought it was interesting, some of this data that just came out, and like I said, I will continue to report on this as we get more information. But I think this is one of those things where time will tell. I think there are some pros and cons to CECL. I think having the data is great. Whether or not the method how this thing ultimately, whether this thing ultimately works or doesn't work, I think is yet to be determined. I think we shall see, and we'll go from there. So okay. I will wrap this episode up with, if you like this episode, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we're on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. Check out some of the other content I have up on the channel. I've posted up a lot of great episodes in banking, finance related, economics related, all kinds of good stuff. So, and then please don't remember, tomorrow night, live stream, BND Strategy Room, live stream every Friday night, 7 p.m. I'm usually live for somewhere between about an hour and a half time frame. But definitely come that's Eastern Standard Time. For anybody who doesn't know, I'm in Pennsylvania, so I'm on the Eastern Seaboard over here, as it were. So, but come check it out. Like I said, live stream on YouTube, 7 p.m. And I hope to see everybody there. That's all I got. So that's all I got today. As Ferris Bueller famously said, "You're still here? Why are you still here? Go away. Go home. Go home." All right. See everybody.